Welcome to the September 26, 2022 Advanced Report from McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, president of McGowan Group Asset Management, a team of 10, a team that cares, and the team that you want on your side if you're an affluent family during market crisis. And we had one this week. I'll call it the Fed Smackdown. The Fed essentially said beatings will continue until morale improves. They even referenced in their projections that they want higher employment. I guess as long as higher unemployment, I guess as long as they don't lose their job, it's okay with them, right? So they're battling inflation. And I'm going to show you what happened to the interest rates and some opportunities created by that along the way. Now, as we go through this, we're going to look at what happened back in June here on the S&P 500. So, year-to-date total return, and actually the sell-off on Friday took it to a minus 22% for the S&P 500 so far this year. These meltdowns that you see correspond to the Federal Reserve meetings where they said we're going to raise interest rates without providing definition of how high they think they need to go to contain inflation. Newsflash, I'm going to give you the case that inflation has already disappeared, and I've got compelling evidence of that. That's going to be one of the most important optimistic potential news stories going forward in the fourth quarter. But we have built in a modest recession based upon Fed rhetoric, and we really did it at the height of pessimism, June 15th. Now, on Friday's trading, S&P 500 actually was still slightly above at the lows of the day this actual number. Now, does it break that bottom? It could. Kramer had said that's the bottom and we may retest the lows, which we just did this week. Kramer's not always right, CNBC's Kramer, but I like him, and his broadcast has a lot more bells and whistles than we can do here at McGowan Group YouTube. Why is this important? It's the height of pessimism. The pricing that you saw here and this relief rally really corresponded to the fact that the Federal Reserve says we don't care about the economy, we care more about inflation. But their dual mandate is what? Employment and price stability. And of course they added the third, climate change, which we'll get to some of the repercussions and what that tells you should do. Here we go. Now, S&P 500, one of the reasons for this decline, see this right here? Third quarter earnings start to come out in October. They're expected to drop slightly. They're still substantially higher than they were a year ago, right in here. But what does it mean for the markets? Well, from there, S&P 500 earnings, it may be optimistic because these are analyst projections, but they start to rise from there. Wow, that could be good, compelling news that we would get after October and especially during January. We want to get prepared for that with the best bargains and real cash flow. Now, in the S&P 500 graph that you saw, that tells you, when you looked at that decline, that tells you it's very hard to do the indexing strategy. It's a lot of fun when you're making new highs, but people tend to abandon that strategy at low points, which is why it fails for most investors. Yes, at high points, the index may beat lots of other choices, but the problem is when you go down 22% in a year and you hear all the bad headlines, what are you going to do? You're probably going to sell a basket of perfectly good assets because there's no assurance and there's not enough cash flow to keep you in it. How did we make money from 2000 through 2012? The Dow finally reached break even in 2012. We had our net cash flow booked during that time and sometimes reinvested, and that's how we won when the market was in an ugly cycle. Now, this is bankrate.com. This is the home mortgage rate. And so I wanted to see, Alex and I wanted to see 6.5% is now the new mortgage rate. Wow. So he locked in his at 2 3/4 because Alex is a great trader and he bought well. But here's my point on this. Look at that. This is the highest mortgage rate since 2001. Historically massive. And what did that cause? Well, the 10-year Treasury is the basis for this. I'm going to show you the 10-year Treasury here, and it is the highest rate since 2011. All right, that was in that recovery. And this was the path of interest rates when inflation didn't materialize. But that high mortgage rate is already starting to cause something, and it's called deflation. This is the Treasury rate. Treasuries, get this, if you go 18 months, you get over 4% on a Treasury because the markets are expecting the Fed to do another rate increase or two, maybe November 1st and December at those meetings. That's what the market's building in. But whoa, wait a minute. First, they don't want to see job losses, but they may already have deflation. And that would be great news. This gives you a nice chance to give yourself a pay raise with great assets. Energy infrastructure, oil fell to 78. That's ridiculous, especially when OPEC is 4 million barrels below their quota in their production capability. They can't even hit their quotas in production right now. And that's going to get reflected over the next few months, according to Goldman Sachs. Well, so energy infrastructure, medical dividends, very inflation friendly. And now global high yield priced at 75 cents on the dollar with sometimes 8, 9, 10% yields. That's a wow. And that says when the Fed stops, all that stuff is likely to give you a really nice gain. And the Fed may stop sooner than expected. Look at this. Existing home sales. 25% reduction in activity in housing already. They call that a freeze if you're a real estate agent. Now we go over to the existing home sales median price. Wow, the past 90 days, that has dropped substantially. It's about 6%. This is the first time home prices have come down, and that's a component in inflation. What else is in inflation? Wow, this is the Ukrainian peak in wheat. This is the peak in corn. You can see all that inflation. Well, it's still in the trailing 12-month numbers. Think about that. And it's going to roll off. What? I got the evidence right here. Corn is down from its peak substantially. And when we look at the cotton, another agricultural component, that's big deflation. And look at this. When you go to cotton, it's below last year's price. That's deflation, not inflation. So the last 6 months, you've got disinflation, deflation. It's going to show up in 3 weeks in the September report. Remember, we had producer deflation in July and August and potentially here in September. Looks like that's what's going to be reflected. What about building materials with the housing market freezing? Look at this. You get this peak corresponding similar to the invasion, but the housing boom pushed lumber to $14.64. Copper went to $5. Remember, this was a huge building boom that is likely over. Wow, what's happened? You've got massive decreases below last year's pricing, deflation in 2 major building components, copper and lumber. That's huge. Lumber's actually down about 70%. That's deflation, and that's going to start to show up in the numbers as we go forward, meaning inflation may already be contained, and that may not be the biggest worry going forward. I'm Spencer McGowan, President, McGowan Group Asset Management. Thanks for tuning in to YouTube. When you subscribe, you're going to get alerts on fast-breaking news in tough markets like this week, which is actually a great opportunity to add good assets and reinvest that cash flow. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowan Group Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowan Group Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.